Okay, let's unpack this. Welcome to our deep dive into today's midday market check, Tuesday, August 5th, 2025. Our sources are painting, well, a really complex picture. You've got major indices seeing broad-based gains, yet individual stocks, they're experiencing some dramatic, almost jarring volatility. So our mission for you today is to really get a handle on what it means to be in a market of stocks, not a stock market.
Yeah, it's fascinating. You see this overarching market optimism, right? It's largely fueled by, well, a pretty positive second quarter earnings season overall, and also these persistent investor hopes for Federal Reserve interest rate cut, probably September.
Yeah.
But that optimism is just clashing head on with some severe company-specific events. It really is creating a treacherous landscape. The big picture doesn't quite capture it all.
Right. So what's actually powering this market surge? And how solid is that foundation anyway? It seems like it's built on two main things. First, yeah, lots of companies delivered strong Q2 earnings beats, that helps. But maybe more surprisingly, negative economic news, like last week's weak U.S. jobs report, is actually being seen as positive for stocks.
Which sounds counterintuitive.
Exactly. Why? Because it seems to solidify the conviction for a September Fed rate cut. We've seen the probability of that cut just soar. It's nearly 87% now after that jobs report.
And this dynamic, it's interesting because it means the market's basically cheering signs of economic weakness. It sees them as a catalyst for the central bank to step in. So for you, the listener, the critical thing here is that this market advance seems based more on the hope of stimulus than on, genuine organic economic strength. Makes the whole rally feel kind of fragile.
Yeah, fragile is a good word. And you can see this divergence playing out so vividly in medtech today. On one hand, you've got Star Surgical, ticker STAA. Its shares just rocketed up over 40%.
Wow, 40%.
Yeah. It came after eye care giant Alcon announced a $1.5 billion acquisition of Stare. Seems like a strategic move for Alcon. They get Star's Evo implantable Collamer lenses. And it's a valuable exit for Stare. They'd face, quote, significant headwinds from demand issues in China. Their Q1 sales were down like 45% year over year. So this deal, it's a 51% premium over yesterday's close. Big jump.
Okay, but then you have the stark contrast. Their medtech peer, Inspire Medical Systems, INSP, their stock took a catastrophic plunge, more than 40% down.
Oof. Despite good results.
That's the key thing. It happened despite them reporting solid quarterly results. Their adjusted earnings per share, non-GAAP EPS, were more than double what analysts expected. Revenue beat too, but those past positives. Completely overshadowed by a devastating cut to their full year 2025 outlook.
The guidance.
Exactly. Inspire slashed revenue guidance from around 955 million down to 900 to 910 million. And even worse, the full year adjusted EPS forecast was just gutted, cut from over $2.20 down to like 30 or 50 cents.
Wow.
Yeah. Management blamed a slower than expected U.S. launch for their new Inspire V system. That triggered a whole wave of analyst downgrades. So for you listening, this just shows how brutal it is. Forward guidance can completely crush even strong past performance right now.
And it wasn't just those two huge movers. We saw other, maybe more nuanced earnings reactions.
Yeah.
Great Lakes Dredge and Dock, GLDD, that surged over 8%, posted a big earnings surprise, strong backlog. But then conversely, Caterpillar, CAT, the industrial bellwether, they missed their adjusted EPS forecast, said they had significant pressure on profitability, margin contraction, tariff issues.
And stepping back, the broader macro data just adds another piece to this puzzle. The U.S. trade deficit, it narrowed sharply down to about $60 billion. But here's the thing. It wasn't because exports boomed. It was driven by a massive, almost $13 billion plunge in imports, especially consumer goods and cars.
So that suggests maybe domestic demand, consumer spending, business investment, maybe that's cooling off.
It can suggest that, yeah.
Yeah.
Which doesn't quite fit with the overall market optimism we talked about earlier.
So putting it all together, it feels like the Federal Reserve is facing this kind of split-screen economy. You've got data from manufacturing, international trade pointing to a slowdown, but then other reports, consumer spending, auto sales, they suggest things are still holding up okay. Resilience. How does the Fed set one single monetary policy for that, for such a two-track economy?
It's a real dilemma for them. And that definitely contributes to the market's choppiness, all this back and forth.
So this deep dive, it really reveals a market just defined by divergence. Stark divergence.
Yeah, that old saying, a rising tide lifts all boats. That is certainly not happening right now.
Absolutely. It's clearly what people call a stock picker's market.
Yeah.
Deep analysis of company specifics, fundamentals, profit margins, that forward-looking guidance we saw Inspire, that's paramount. For you, the listener, understanding these micro-level details, these nuances, it's just more crucial than ever.
Which leads to a final thought. What does this intense market selectivity mean for the long-term health of the broader indices? Especially these company-specific problems keep outweighing the overall positive sentiment. How long can basically hope for the Fed sustain this kind of fragile rally without some genuine underlying economic vitality kicking in?